This is Crisis Report USA, and tonight, the world's confidence in the US dollar is beginning to fracture. Foreign central banks have just unloaded more than $130 billion in US Treasuries, the steepest liquidation in more than a decade, sending tremors through the global financial system. For the first time since 2012, America's foreign custody holdings at the Federal Reserve have fallen below $2.8 trillion. To most people, that might sound like just another line in a spreadsheet. But for economists, this is the sound of the global economy shifting beneath our feet, the slow crack of trust breaking in the world's reserve currency. The data comes directly from the Federal Reserve's weekly custody report, the closest thing we have to a live window into how much US debt is held by foreign governments. In just 8 weeks, those holdings plunged $130 billion. That isn't rumor, speculation, or politics. It's hard data published by the Fed itself. Now, some analysts still point to slower-moving sources, the Treasury International Capital Report or the IMF's COFR survey, which appear to show steady global demand for U.S. assets. But those reports lag the market by months. The Fed's custody data refreshes every week. It's the heartbeat of the dollar. And that heartbeat is starting to skip. Back in the spring of 2025, foreign demand for U.S. Treasuries actually reached a record peak. But almost overnight, the pattern flipped. According to economists at Standard Bank and Deutsche Bank, this reversal is happening even as the dollar itself weakens, the opposite of normal. Traditionally, central banks sell treasuries when the dollar strengthens to protect their own currencies. This time, they're selling into a falling dollar. That's rare. And it's dangerous. It means one thing. Central banks aren't just defending their currencies. They're questioning the future of the US dollar itself. If that's true, the United States could be staring at the first visible cracks in its financial foundation. The US dollar index has already logged its steepest half-year decline in more than 50 years, down roughly 11% between January and June. The long bull run that began back in 2010, the so-called King Dollar Decade, may finally be ending. Why is this happening now? Because the numbers no longer add up. The US debt to GDP ratio keeps climbing, with no credible plan from Washington to stabilize it. Interest payments on the national debt are exploding, swallowing a larger share of federal spending than ever before. America's trade and current account deficits remain deeply negative, meaning the country must constantly attract foreign money just to keep the system running. At the moment, foreign investors hold about $7 trillion in treasuries and nearly $18 trillion in U.S. equities. That's a quarter of the entire treasury market. If even a small portion of that capital begins to shift to other currencies or commodities, the dollar will face sustained downward pressure, not a collapse, but a slow, grinding loss of dominance. Still, the dollar isn't finished. It continues to account for almost 60% of global foreign exchange reserves, dominates about half of all international trade invoicing, and appears in 9 out of 10 currency transactions worldwide. No rival, not the euro, not the yuan, not even gold, matches its liquidity, depth, or global trust. Yet the edges are fraying. Central banks are quietly rebalancing their reserves. They're not abandoning the dollar, but they are hedging against Washington's growing fiscal recklessness. And their hedge of choice is gold. In 2024 and 2025, central bank gold purchases hit levels unseen since the 1970s. This isn't random, it's a signal. Gold doesn't replace the dollar, but it exposes a lack of confidence in Washington's ability to manage its own balance sheet. This erosion of faith didn't start last year. It's been building for decades, through debt ceiling standoffs, government shutdowns, reckless spending packages, and partisan gridlock that made the U.S. look less like a financial anchor and more like a risk. Even the Federal Reserve, long considered the gold standard of central banking, now faces political crossfire. After raising rates aggressively to tame post-pandemic inflation and shrinking its balance sheet by nearly $2 trillion, the Fed's independence is under attack. President Trump has publicly called for faster rate cuts, pressuring the central bank to loosen policy ahead of the 2026 election cycle. Reports have even suggested attempts to remove a sitting Fed governor, an unprecedented move that sent ripples through financial circles worldwide. When global markets sense that America's central bank might bow to politics, trust evaporates. Because the dollar's credibility depends on one thing above all else: the perception that the Fed acts independently. Undermine that, and you undermine the dollar itself. At the same time, geopolitics is making everything worse. The renewed tariff disputes, shifting supply chains, and Washington's strategic rivalry with China and Russia have fractured global trade. Foreign reserve managers see the risk. They see the endless debt debates, the swelling deficits, and the political battles that threaten to weaponize the economy. So they've begun quietly reducing their exposure to U.S. assets, not out of anger, but out of caution. The truth is simple: the dollar's dominance has always been built on trust. Trust in American institutions. Trust in fiscal discipline. Trust in the rule of law. But that trust is wearing thin. What's happening isn't an overnight crash, it's a slow erosion. The beginning of a long transition toward a multipolar monetary system where no single currency reigns supreme. A system where emerging economies have more independence and the U.S. loses some of its financial gravity. For decades, the dollar was untouchable. It wasn't just money, it was power. But now, even allies are looking for alternatives. India is experimenting with rupee-based energy deals. Saudi Arabia and China are pricing oil in yuan. BRICS. Countries are pushing local currency trade agreements. It's still early, but these cracks are spreading. And behind all of this lies one central question: how long can America's financial dominance last when the rest of the world is preparing for life beyond the dollar? If this trend continues, if more countries diversify their reserves, increase their gold holdings, or use alternative payment systems, the U.S. will lose a critical source of global leverage. The power to sanction, to isolate, to pressure, all depends on the dollar's supremacy. Meanwhile, Washington keeps spending. Federal debt has crossed $35 trillion, and interest costs alone could soon surpass the entire defense budget. Investors see that trajectory, and they're asking, how sustainable is this? The U.S. isn't just fighting inflation anymore, it's fighting gravity. The dollar remains the backbone of global trade, but that backbone is starting to bend under the weight of debt, politics, and polarization. Even as some argue the dollar will remain unchallenged, history says every empire believes that, right until it doesn't. If these Federal Reserve custody numbers are the canary in the coal mine, then the message couldn't be clearer. The world is quietly preparing for a future where the U.S. dollar is no longer the center of gravity. For ordinary Americans, this isn't just a macroeconomic story. It's personal. A weaker dollar means higher import costs, more expensive debt, lower purchasing power, and slower growth. It could reshape the global balance of power, shifting wealth, influence, and opportunity toward nations that spent decades waiting for their turn. The dollar is still king, but for the first time in generations, its crown no longer shines with certainty. So the question isn't whether the dollar will fall tomorrow. The question is whether America will rebuild the trust that made it the foundation of global finance in the first place. Because once confidence fades, it rarely comes back the same. This is Crisis Report USA, revealing the truths behind the numbers, the politics, and the power shifts that define our time. Stay sharp, stay aware, and we'll see you in the next report.